My view of stewardship is the gifts and the skills that I've been given are not for me and they're not mine. They were given to me. And so I am going to be held account, I believe, before God one day and say, what did you do with what I gave you? And I want to be able to say, I gave everything I could to maximize the gifts that you gave me.
Welcome to the Build It to Billions podcast, where we guide successful entrepreneurs and investors on the journey from millions to billions. We believe that the key to scaling your business and compounding your wealth starts every single day with the mindset and practice of stewardship over ownership and applying billionaire biblical principles. Our ultimate goal to help you scale and compound your wealth and life so you can give more or all of it away to help MVPs. I'm your host today, Brett Swartz. In every episode, we feature some of the world's top entrepreneurs, millionaires, and billionaires. They share their insights, principles, values, and secrets, providing each of us with the wisdom we need to reach the next level of faith, success, and impact. I'm excited about our next guest. He is the CIO at Aspen Funds, where he combines his analytical nature with the passion for delivering outstanding client service and strong returns through out-of-the-box investments. With a professional background that spans over a decade, he's become an expert in the field of investment management and has worked for several reputable financial institutions. He is the co-host of the Invest Like a Billionaire podcast, where he joins his father, Robert, co-founder and CFO of Aspen Funds, along with co-founder Jim Mfushi, to discuss economic trends and the best practice for alternative investing. So much more. More than all this, Ben Fraser, who's coming in here, has become a friend. He is has a heart for not only service and returns, but also a heart for making an impact, and makes him a perfect guest for the Build It Billions podcast. Please welcome to the show with me, Ben Fraser. Ben, how are we doing?
Doing well, man. Thanks for having me on. Looking forward to it.
Absolutely. For our listeners, get to know you for the first time, would you give us just a little bit more about your story and your current focus?
Yeah. So like you kind of mentioned, I've been kind of in the investment world for most of my career. I spent most of my time in commercial banking, actually, as a lender and an underwriter, and then kind of joined the world of private equity probably about 7-8 years ago. And it's been pretty cool. A lot of layers to the story, but I get to work with my father alongside two other partners, which has been a really cool story in and of itself, but it's been really fun. So I joined about 7 years ago. At that point, it was just friends and family money that we had raised. And we've since kind of been on a rocket ship growth path. And really what guides a lot of our kind of story is looking for what we believe to be the best risk-adjusted opportunities based on the macroeconomic landscape. And those are a lot of big words to basically say, there's better times than others to invest in certain asset classes and strategies. And we want to be in front of those changes of the tides to, make sure our investments are going to perform the best they can.
Absolutely. And out of Colorado these days, what we're going to be talking about today is building industrial commercial real estate wealth. Before we dive into all of that kind of cool stuff, I do want to take one other step back, Ben. I believe we've all been given certain gifts in this life, and these gifts have been given to us to be a blessing and help to others. This is part of the stewardship part of this. And so maybe Ben growing up a little bit, who was Ben, right? You had a big successful dad who's doing a lot of cool stuff, right? And then you're paving your own way as well, and you're growing. But are there certain gifts or strengths that you were like, boom, I was given, that you feel like you were given, and how do you use those to help and bless people today?
Yeah, well, depends how far back you want to go, but my story is interesting because growing up, I actually felt like I had an identity crisis. I think we all do to some degree in different times, different periods, but I'm always kind of been the guy that's pretty good at a lot of things, but not really good at just one thing, right? And it always bothered me because you see all these standouts, right, early on, to where they're just naturally gifted at one thing, and it was so obvious. Whereas for me, it's like, I was pretty good at this, pretty good at that, pretty good at this. And it was frustrating because it wasn't really clear to me what I should be doing. But as I've gone later in my career and have seen how much, not only we all have a baseline of skills that we're given, but to me, so much of the stewardship piece of it is what are we doing with what we're given? And then how are we compounding on that, right? Because what I've learned is compounding is the eighth wonder of the world. We all know that from an investment standpoint, right? It's crazy if you start to understand the math behind it. But what I've actually seen as well is the gifts that we're given, if we use those and compound on the learning, it also can compound knowledge. It can compound mindset, abundance. And so the reason I say all that is, as I look back now, 15, 20 years later, um, it's taken me a little bit longer maybe than some, but I also can see this. I have the ability to see things at a high level and put together complicated puzzle pieces to all fit together and make things happen. I feel like that's kind of my unique genius, and it's never one thing, but it's the combination of putting all these different things together to bring out something really cool.
Oh yeah, I see it. I see it. I sense it. And as I get to know you more, it makes sense. And then your background, you said it from the banking part,
Yep.
right? And then your analytical mind, and then bringing it together. And then like, I feel like it's the Rubik's cube, maybe. And then you can like, kind of like twist it and turn it and perhaps get these things to line up. Is that a fair summary?
Totally. I mean, yeah, early on,
Yeah.
all I wanted to do was become a rock star. I loved music. I was a decent guitar player, decent singer. But then I was like, I'm not good enough to like do this full time. Then I loved cooking and wanted just to cook food and become a chef. And then I loved math. I was pretty good at math. And so I was like, how do all these things kind of fit together? Like these are all weird, unique things, but over time, as you invest into the things you're gifted at, it can kind of come together. It's cool to see it all come together.
That's awesome. I love it. Yeah. So with that in mind, let's dive into the topic at hand, which is building industrial commercial real estate wealth. It'd be great, I think, for the listeners to hear about Aspen funds, right, as a whole, and then kind of narrow in of how you guys on this particular niche you're focusing on right now. And we can even touch on the oil and gas as well after that.
Totally. So I kind of gave a little brief summary, but on Aspen Funds, it was started by my father and Jim, our other partner, about 11 years ago now. And it was really coming out of the great financial crisis. Both of them had their own unique stories and their own unique kind of journeys to get to that point, and different pain along the way, right? A lot of these correction in the cycles, economic cycles, changed the game. And so what they saw was a changing game, a changing economic tide. And they saw an opportunity that at that point was kind of early stages, but buying distressed debt, buying distressed mortgages in 2011, 2012. And it was really kind of the beginning of the genesis story of Aspen, but the kind of way that they approached it was, let's look at the big picture. Let's understand what's going on in the economy, because there's better times to invest in certain asset classes than others, right? And it was really good time to be investing in dot-coms in the late 90s, not so good early 2000s. It was a really good time to invest in real estate in 2005, 2006, not so good in 2008, 2009. Commercial real estate like apartments, same thing. In, 2020, 2021, not as good right now, at least a couple of years ago. And so there's these cycles that as investors we intuitively understand, but we don't always think about how that impacts the investments that we're in, right? We're usually too late to the game. By the time something becomes popularized or the main headlines everyone knows about, it's usually an indicator that it's too late, right? Everyone else already knows about it. And so what that's done is kind of created an emphasis for us to go and try and basically skate to the puck, right? I'm not a hockey player. I've heard it before, so I use it, as an analogy. But when you're skating to the puck, you want to go to where the puck is going to be, not to where it is right now, right? And so you want to preempt and understand what are the drivers of the economy, what are the drivers of population growth, what are the drivers of, in this case, in industrial real estate, manufacturing and distribution. The whole landscape is completely shifting, and I'll get into that in a minute. But as Aspen Funds, we've kind of used that methodology to first look at the big picture to determine where we go for the investments. And oil and gas is another great example we can talk about later. So we have a very broad kind of portfolio in a lot of different asset classes, and we can kind of pivot to where we think the best opportunities are. And we build really good teams and strategies around each vertical we're in. And now I've been doing this for over 10 years with a lot of investors, and continue to keep growing from there.
Awesome. By the way, you want to learn more about Ben Fraser and Aspen Funds, you can simply go to aspenfunds.us. That's aspenfunds.us. Yeah, I like the way you said that, skate to where the puck is going, not where the puck is at, and being flexible, nimble, and I also say humble enough to not fight the tides or fight the times that we're in, and really take it from an investor, manager, analytical perspective. Let the data speak to where and how to invest probably within the realms, right? With its, real estate, looks like some oil and gas, some debt, right? But kind of in that world that maybe we considered alternative investments, but it's where the exponential, and I think a lot of the wealth has been built in America, right? And so it sounds like you guys have been open to what the data and open to what the macroeconomics is going on. Is that a fair summary so
Yeah,
far?
absolutely. Absolutely.
Okay, cool. So let's dive into industrial commercial real estate, and in particular this raise that's happening in Kansas, and kind of let's sort the kind of the broader what's happening in the world, and then let's dive into the deal that you guys have recently done with industrial and how you're going to be kind of duplicating and improving upon that model.
Yeah. So industrial real estate is interesting because it's an asset class a lot of retail investors don't know as well, but it's really a darling of the institutional investors, right? It's been a primary investment vertical for a long time. And up to this point, it's really been driven by the e-commerce boom, right? As e-commerce was taking over the world, and all these big companies like Amazon needed places to store all the inventory and to ship it to the end user, that became this huge kind of we'll call it an economic tide, right? The rising tide's lifting all boats. So industrial as an asset class really really grew in that 2-decade period. It's starting to plateau from the e-commerce boom, but what's really driving what we believe to be the next boom in industrial it's a little bit of a different story, right? Instead of e-commerce, while it still is a growth story, it's not to the same level that it has been. The real change has really been post-COVID. The whole supply chain ecosystem is completely changing, right? A lot of companies are deciding to rewrite how their supply chains are getting from raw material to end product to the end consumer. And when I was in school and I went, got my master's in business, and the big thing we learned about, usually, higher education is about 2 decades behind on everything. The big thing was just-in-time inventory, right? It's the globalized manufacturing supply chain system that you press a button here, and the factories get notified in China, and it gets here right when you need it, right? And that's a good story. And as a globe, we globalized this supply chain to be very efficient. But the problem was the calculus did not account for what happens in a global pandemic, right? Or when political risks that we're not really thinking about impact, do we actually want to trade with this company? And so it's throwing a wrench into all these different pieces of the conversation and the calculus these companies are now making, to where the decision points are actually much different than what they were before. And if you now look at it side by side, it's not that much more expensive anymore to manufacture in America or in Mexico than in China or other places where wage growth has been insane, transportation costs have gone up, political risks have gone up. And so what we're seeing in the US is a massive resurgence of manufacturing. It seems kind of crazy to say, because we used to be a pretty big, manufacturing economy, several decades ago in the 80s. And that kind of shifted, but it's really coming back with a real big resurgence. And it doesn't depend on who's in the president's seat or not. It's something that's happening regardless, because these are big picture seismic shifts in the industry. So just some quick stats we've seen just in the past 2 years. Job announcements in the U.S. for manufacturing jobs are up 66% in 2 years. 66%. We're seeing the investment into U.S. Factory spending. So this is not just the real estate, but this is the technology. This is all the ecosystem around supporting manufacturing has tripled since 2021. not just 30%, tripled, 300% increase to over $200 billion just last year. In just the U.S. And we're seeing it in every industry. We're seeing it in automotive. We're seeing it in technology. We're seeing a big push into EVs, right, and battery technology, et cetera, with the CHIPS Act. And then the other big factor here is the energy landscape, right? One of the things we don't think a lot about as Americans, but we're extremely blessed by, is we're an energy independent country. We produce our own oil, our own gas, and we're the largest exporter of oil in the world. People don't really realize that, right? And what that means is for manufacturers, you think about some of the biggest line items on their expenses are going to be one, labor, right? But two, it's going to be energy. It's very energy intensive generally to manufacture. And so in Europe, it's a totally different situation. They don't have the same type of they don't have fossil fuels to be able to generate energy like we do in the U.S. And so it's very much more expensive there. And so energy is a very large input cost is driving a lot of decisions back to the U.S. because of our energy independence. So all these factors are just creating this pretty big seismic shift that is a multi-decade long reversal of the what I call over-globalization.
Okay, wow, that's actually really encouraging and makes a lot of sense of why industrial commercial real estate makes sense right now. And it's beyond just the e-commerce boom that's kind of there, although it's still a good tailwind. But really, supply chain, and it makes sense. Like if you're counting on politics, you're counting on countries to be able to deliver stuff from overseas. It's a lot of things that can go around that are out of your control. You might as well just say, hey, can I go closer? Especially if the wage gaps are shrinking, if you will,
Yeah.
right? Makes a ton of sense.
Think about
So
this.
66%.
This is kind of a crazy story to make the case in point here. So, coming out of COVID, Ford, the big auto manufacturer, they had a ton of demand for all their vehicles and their trucks, right? So they're trying to produce as much as they possibly can. But there is a huge bottleneck with the chips, the electronic chips that go in to just make the car and truck actually work. And so at one point, I forget the exact number, it was around $4 to $5 billion of inventory of completed trucks and cars that were sitting on lots that they could not sell because they didn't have these little chips, right? And so you think about like, what's the value to Ford in that scenario well, maybe it even is a little bit more expensive to produce in the US, but if I have confidence of I know when I can deliver this, and I'm not waiting on Taiwan or some other country that has a whole other political, economic issue going on that I can't control, and I'm at the whims of what they're going, I'm leaving a ton on the table that I'm willing to bring that and de-risk that part of the supply chain, right? So it's not for everything, but if it's for critical components that I'm going to change where I'm going to do that, I'm going to have more control over it. And then just having more inventory, right? Before it was just in time inventory. Let's just wait until we need it. But now they're realizing, hey, when we needed it, we couldn't get it back in COVID. So we actually want to keep more on hand so we don't run into that same issue again. So these are the things that are changing the calculus, right?
Yeah, which indeed leads to more industrial, more storage, more manufacturing, which are these large buildings. And so let's talk about that, right? The current raise for the current deal. Give me some of the specs, give me kind of the vision and a little bit of the business plan.
Yeah. So the cool thing with this is it's basically a repeat business plan that we've already executed on successfully. We're bringing all the same, I call this the same band members back to do the reuniting tour here and execute on the demand. So this demand driver for manufacturing and industrial buildings is very, very strong. It's been a little slower the past 12 months with the economy slowing down, but pretty much every prediction you look at, it's going to turn very, very quickly. And even despite that, we're actually seeing a lot of demand, even with the slower economy. So usually with slower economies, companies don't want to necessarily expand or take on, opening new factories, other things, because they want to see what the economy is going to do. But even despite that, because this is such a big, what we call mega trend, that they're just saying, hey, we know over the next 10 years this will bear out, so we're going to do it anyway. So this particular deal, it's a repeat of what's already been working. One of the cool things in industrial, as compared to say multifamily or others, when you're developing, is your yield on cost, right? So not to get too technical, but basically, what's the yield or the return that you can generate without debt based on the cost that you have to spend to generate that yield, right? So it's kind of the ultimate metric of, what's the highest upside that I have based on every dollar that I'm spending. In multifamily, it's just way more expensive to build. So we have already a lot of margin in industrial because you can get a lot more yield relative to the cost. And then the other flip side of it is, what can I sell that yield at? That's your cap rate, right? And for the most part, industrial does not trade at much of a premium to multifamily because, like I said, it's a darling asset class of institutional investors. So what does that mean? You have higher margin, you have higher potential upside with still pretty high demand for that yield. So it just creates a lot of margin. You can get gross max contracts on your construction, so you don't really take a lot of construction risk. We work with local lenders that know the markets, that know us, so we're not taking on a lot of debt risk. And so we're kind of trying to eliminate as many of, or at least mitigate a lot of the risks as possible, and really play this mega trend and repeat what we've had as a successful project just recently that's done very well for investors, and play into this mega trend.
Let's dive into that very well, right? So people have some real numbers. So if someone had put $1 million, let's say, into an investment, but the last one, what was their average cash on cash, and what was their total kind of return on equity on the way out?
Yeah. So in industrial, it depends on your strategy, right? With us doing a development strategy, there's not a lot of cash on cash, right? Because you're basically building, you have no cash flow until you get a tenant in play. And then our goal is to sell the asset once it's stabilized, and we can sell that yield to a big institutional investor or a REIT or something. So what you're really looking at is IRR and total yield, or total equity multiple. Those are the kind of the bigger numbers you look at in development. And in this case, it's unrealized, meaning we haven't sold the project yet because, one, we don't think it's a good time to sell, because we think yields are going to continue, or interest rates will continue to come down. Demand for that yield will continue to come back stronger. But on an unrealized basis, we've generated about a 60% return in about 18-month time period, with today's values from appraisals that we've just recently got. So it's not realized, right? And I could go sell at that, but I think I can sell at a higher number a year or two down the road. So we are going to hold with our tenant in place. It's a national credit tenant. And again, caveats, projections, there's no guarantees of these results on any future deals, but these are types of things that we're seeing, right?
Okay, so let me bring this to life. So if someone had put $1 million in with Aspen funds on that industrial project about 18 months ago, that million as of today would be worth about 1.6 million. Is that a fair summary? Yeah, pretty sweet. And then in the meantime, if interest rates come down and everything goes the way that it could go, that could go higher, is what you're thinking.
It'll go higher because we have inflation, what's called rent escalators built into the leases. So the lease rates increase over time, and then as cap rates come down, that'll also increase the forced value down the road.
Sweet. So now let's compare that deal to this one coming up here. What are the similarities? What's the template? What's the blueprint? Is there anything that you're changing from that last one, or how does that look?
Yeah, well, it's worked very well. So we're not changing a whole lot, other than we've got what we think is a better location in the same market. It's in the nicer part of town. It's where a lot of developments happening, or just economic activity. Not a lot of development actually, but a lot of economic activity right by the highways, to get basically anywhere in the U.S. within a day's drive. And the really cool thing about the Midwest, and another reason that this is such a strong case for manufacturing, is, I mentioned earlier the two biggest costs for a manufacturer, right? Labor and energy. We talked about energy, but labor is really, really important, right? So when a firm is looking at, where do I want to actually build my plant, one of the core factors they're going to look at is, one, distribution. How fast can I get my product to the end consumer, and how quick what's my access to highways, and that. But the other big piece of it is, what's my access to labor force, right? I want a really good, strong blue collar labor force that's not that expensive. So we're seeing a big shift from the coastal markets to the Midwest and the southern part of the United States, where the labor is a lot cheaper and it is a more historically manufacturing centric type of economy, right? And so that's another advantage of these kind of Midwest uh, places where it has a great draw for the end tenants because of the underlying workforce.
Perfect. So labor, energy, cost of living, all of these make sense for why Kansas and why this project. So maybe give us some quick stats, like what's the size of the project, what's the equity raise, what's the timing of it, what's that kind of looking like?
Yeah, it's about a $40 million project. We're doing two buildings, about 200,000 square feet in total. The cool thing about that is we can build these bigger shells. We kind of try and get a single tenant per building, but we also have the ability to demise. And what that means is basically chop up into smaller pieces and bring in more tenants. And you actually usually charge a premium when you do that. It's simpler to get one tenant, but you kind of have to play to what the market's giving you. And the way we build these, we can go either way. We can go more distribution warehousing type of tenant, or we can go more heavy manufacturing. We can do both. And it really depends on what the tenant mix is going to be once we complete it. So we have a mass appeal. We have two buildings, but it can be multiple tenants if needed. We're raising about $13 million. We've got debt lined up, really, really great debt terms with a regional lender, like I mentioned. And project's going great so far.
Absolutely. And by the way, Capital Gains Tax Solutions is proud to announce a new strategic alliance with Aspen Funds, where we will be bringing capital to Aspen Funds through the deferred sales trust for a lot of our clients. Our clients love industrial. They love multifamily, mobile home park. It's those are the three that are their favorite, and we're excited to be bringing capital to Aspen Funds. But if you want to connect with Ben directly, go to aspenfunds.us. Mention you watched us on the podcast here as well. If you're looking to sell a highly appreciated asset and you want to set up a deferred sales trust, we are here to help you at capitalgainstaxsolutions.com to get started there with me and my team to find a way to unlock that capital, but place it in deals like this that make a ton of sense. And it's hard to miss on this kind of thing, Ben. I mean, at the end of the day, industrial is not going anywhere. It's only going to grow, like everything you're saying here. And it really hasn't got hit at all. In these last 10 years, it's only gotten stronger and stronger and stronger. Multifamily, we're seeing that, a lot of deals are sinking because of the debt. I feel like industrial has been one of the real standouts of all of these. I think self-storage has been pretty resilient, I would say, pretty resilient, but industrial seems to be, one of the strongest, if not the strongest out of all of them for commercial real estate. Any last thoughts on that?
No, you're exactly right. If you look at most kind of valuation metrics, right, and sometimes it's a little bit hard to say because not many deals have traded unless they're distressed in the past 18 months or so. But by most estimates, multifamily has been hit about 25-30% from a value standpoint, from what its highs a couple of years ago. Industrial has probably been impacted the least from a value perspective. It's values have come down a little bit off the highs, but not much. It's been remained very, very stable from a value standpoint relative to other commercial real estate. And so that's, again, just shows the resilience of big investors like this asset class, right? And they believe the story that's there. And so even as interest rates come down and you can get more into a positive leverage scenario again, that makes it even that much more attractive.
Absolutely. Let's shift into oil and gas. I think for a lot of investors, they're coming out of real estate, and Aspen Funds is real estate heavy. And then you guys went in oil and gas here recently and doing very well at it. And we're excited to also be working with you guys on the next launch of the next fund for some oil and gas. But talk about a little bit of that journey from real estate into oil and gas, and how you guys structured it with the big group that has a tremendous track record, and how that's going so far.
Yeah, absolutely. So there's probably a lot we could say maybe in a podcast episode in the future, because there's a whole lot of data behind the reason we're excited about this. But at a high level, again, it's the same reason we're excited about industrial is why we're excited about energy. Is there are massive seismic shifts in the energy landscape that are supporting what we believe to be a pretty big opportunity in fossil fuels, right? A lot of people assume, oh, fossil fuels are dead, right? Depending where you live in the country, especially, and renewable energies are the way of the future. Well, yes and no. Right now, what would you guess, Brett, is the global energy usage by type of energy? So renewables or fossil fuels, what would you say from the total globe, how much of that comes from renewables percentage wise?
Oh my gosh, I think it'd be a pretty small one on renewables, right? I would think, but will you tell me?
15%. What, 1 5, right? So when most people hear that, they're thinking, I thought it was at least like 50, right? Or more. And that was kind of my initial thought when I started investing in this asset class several years ago. It's on its way out. But as you start to dig into it more, a lot of it's being pushed from a political narrative of we need more renewables, we need more renewables. I don't want to get into the political side of things at all because I think it's kind of irrelevant to the thesis for why we're excited about it. But what's happened is a few things. One, the the focus on renewables has created these unintended consequences of large capital allocators, large investors that historically invested a lot into fossil fuels, leaving the space entirely because they have to hit their ESG scores, right? ESG is environmental societal governance standards that have been set for basically a score system for how well is your investing helping the environment, et cetera, right? And so because of these scores, it's pushed a lot of capital out of the system because obviously fossil fuel is, dirty, quote unquote. And the what's happened is if you think about oil and gas, it's very different than real estate because real estate is a naturally appreciating asset, right? It naturally goes up with inflation over time. It becomes more valuable. With oil and gas, it's different. It's actually a depleting resource, right? So when you're drilling oil out of the ground, there's a fixed amount in every reservoir, every well that you are operating. And when you pull oil out of the ground, gas out of the ground, there's less of it left in that reservoir, right? And so um, we basically we deplete about 5% of our total production globally. So for simple math, if we're producing 1 million barrels, a day next year, if we don't do any drilling, any new wells, we'll produce 950,000 barrels a day. That's just the natural depletion curve. Investment into new exploration and drilling has dropped by over 50% over the past about 10 years. And so you think about what that means. It's a leading indicator, meaning the drilling that we're doing right now will result in production a few years down the road. But the lack of investment into drilling right now will result in a lack of production down the road, right? It's a leading indicator. And we're not seeing that shift anytime soon. So what's happening is the supply is kind of plateauing, if not starting to decline, based on the oil rigs, the drilling, the current production we have, and the depletion. And then by most estimates, regardless of where you land on the political spectrum of renewables are the future or not, most estimates predict that our need for fossil fuels is only going to go up over the next decade, right? Even if you're extremely left-leaning with the big proponent of renewables, which I'm a fan of renewables, so I want to be clear there. But by pretty much any estimate, we have a declining supply, we have an increasing demand, right? I'm took some economics courses growing up, and that usually implies one thing, right? It's going to put a lot of upward pressure on prices. And so that's really the idea, the big story behind it. And then what we're doing is we are doing a unique strategy that a lot of people aren't doing. We're going and buying existing production. We're buying existing wells at a really good basis. And then we're layering on new drilling on top of that to increase our production, increase total potential return. But it's different than I'm going and taking some capital and I'm going to drill new wells and I hope I strike oil, right? Which there are a lot of those people out there doing that, but it's difficult because it's very variant, right? The returns that you might get could be really good or going to be really, really bad, depending on how those drilling programs go. And so what we're doing is kind of, I think, a great. It's like kind of like real estate, right? You're buying an existing asset and you're improving the asset. That's kind of our strategy here. Is let's go buy existing assets. Most of our assets are operated by major oil companies, publicly traded, large, well-funded, well-experienced companies. We participate alongside of them, and then we can do more along the way. So it's a great story.
It is a great story, and it's exciting because I would say I'm the tortoise, not the hare, when it comes to especially anything outside of the mainstream of mobile home park, multifamily, industrial, right? It's just because I grew up, selling multifamily markets in Millichap, grew up building houses in the Bay Area, California, and just something I just understand. And so for many, many, many years, I get approached with people who do oil and gas. Hey, Brett, look at oil and gas, look at oil and gas. And I'm always just like, I look around and I'm always looking for my real estate people to go first. And so I respect you and your dad and what you guys have done at Aspen Funds. And so I'm like, okay, so I know their level of due diligence, their level of humility to see what the macroeconomics is showing, and their levels of returns that they've achieved, and their thoughtfulness and their values, all of that combined. I'm like, okay, if they're doing this, I know they've done their homework. And they're behind it. So I'm excited about the oil and gas. Although it will be my first time going into anything like this. We've had a couple of DSD clients do a little bit of oil and gas, like some small amounts, nothing large, but that's also going to be an exciting thing coming in the future here. So look for all that. Just some general returns. I know, Ben, that past performance not a prediction of future results, but if someone had put $1 million into the oil and gas about 18 months ago when you guys started all this up, what is that looking like on average, cash on cash? What's kind of, or equity multipliers right now?
Yeah, so it's kind of a different story to development deals, right? Where you instead of on a development deal, you're waiting for the outcome, and you create a lot of value once you stabilize an asset. That's when most of your return happens. The oil and gas, with our strategy, we're buying producing wells. We're buying them at a really good cap rate usually. So we're producing cash right out the gate. So our total return target is usually 20 to 25% annually. And a lot of that is coming from cash flow, right? So when you break down how does that return get generated, when a lot of it comes from cash flow, it's usually a lower risk type of return, right? Because you're getting a lot of it sooner. So right now, we're yielding in high double digits, high teens on the last fund that we raised last year, already a year ahead of our distribution schedule and ahead of our first year distribution yield targets because of.
So if someone put $1 million in, to keep it real simple, they're making on average 16, 17, 18%, kind of that range.
Yep. And that's kind of cash flow annually. And then we expect that to go up as we improve the value of the asset through new drilling. And
pretty sweet, right? $160,000, $170,000, $180,000 in cash flow over a 1 year period of time. Quarterly distributions, annual.
We do
what's
quarterly,
kind of,
and then we have a long. These are long range funds, right? So that's one of the differences here. But we don't know how long it will take for our thesis to play out. We're pretty confident it will over a 10-year period, but we want to have kind of the max flexibility. But the goal is to keep sending distributions for a long time. So total equity multiple can change depending on the length of time we hold it. With our partner on these assets, past performance, not guarantees of anything, but average IRRs in the mid 20s on a fully exited deals, and usually a hold period of around 3 years, but that can be longer. So that's kind of the range.
Speaking with the Ben Fraser, Aspen Funds, if you want to learn more about all of this, please make sure you check out aspenfunds.us, aspenfunds.us. And as a reminder, Capital Gains Tax Solutions is now strategically aligned with Aspen Funds to offer ability for you to exit your highly appreciated assets and get into these types of returns. Coming from California, Ben, it's not really a hard sell anymore because the equity is so high and they're capped at rent, rents are rent controlled, right? And it's getting harder and harder to do business in California. Places like New York, New Jersey, high capital gains tax states, tons of equity. And so many clients are just looking for that freedom and flexibility and that diversification of their capital, right? Into places that are pro-business, that are growing, Kansas, the Southeast, whether it be multifamily, mobile home park, industrial, now oil and gas, but to be able to diversify the portfolio ago within the alternative or real estate space. Talk about the value of that from someone who's considering selling like, a massively appreciated asset that's singly concentrated, and now they have the ability to diversify into stuff like Aspen funds.
Yeah, 100%. I mean, we see it all the time, right? Where people go from actively managing a dilapidated apartment building to investing into a fund, and they get access to, multiple dozens or even hundreds of assets, right? In these oil funds, for example, we have hundreds of wells that you get diversified across. In our credit funds, you get access to over 1,000 different investments in the fund. So you spread out your risk a lot, and then you also have to do a lot less, right? Usually, what I find is the people that are self-managing, they actually make more money investing passively into a fund, and they take less risk because they're diversified into multiple assets. So
And they have more time. And then you couple that with a deferred sales trust. So you've got an extra 30 to 40 or maybe sometimes 50% of the proceeds working for you. Like we just did a deal, just actually closed last week. It's an automotive sale out of Massachusetts. And it was, let's say about 6 million or so hit the trust. And there's another earn out. It's going to be another couple million bucks. But they had zero basis, started this thing from scratch. And now they've got this ability to diversify and invest the wealth and get passive cash flow. And they've never had it like this before. And they're like, wow. And there's an extra, we estimated about 30 to 35% more in proceeds working for them. And they're blown away. And that's the ability of back to the compounding interest, right? So if you can compound on both sides, we call it tax flow and cash flow, right? If you can say my return on equity is, let's say 4 to 7% on average, let's say, and you can move that to just a return on equity to 15 to 18%, and you have an extra 30 to 40% working for you, because it's kind of like an oil mine, right? If the oil is in the ground, like it's sitting there waiting to come out, right? So you've got to figure out a way to unlock the capital. Well, a lot of this capital that's stuck in these deals are waiting to be redeployed and replanted is a good way to think about it. So harvest where you're at. So you get compounding on one side by deferring the tax, and then compounding on the other side by increasing the cash on cash and or the ROE. And then the last one I think I geek out about a lot too is resetting the depreciation schedule, right? And so on the industrial property, and you guys are probably going to do cost seg or bonus depreciation if it's there when it's around. But then you can set up a joint venture LLC, partner with the trust, and let the trust invest alongside of an LLC, which gets a new depreciation schedule. And now you're like, it's like a triple arbitrage situation. You went from your equity being locked up, not diversified, not liquid, not tax deferred. Well, I guess tax deferred while you don't sell it, to tax deferred. And now in this scenario, you wouldn't be liquid, so you're staying with that, but you got a lot more equity working for you, and you've reset a depreciation schedule of which you can get depreciation to offset. And you go, why wouldn't you do it, right? So, but by the way, I'm curious now. A lot of people start learning about the deferred sales trust. I told you and your dad about it at the conference with Hunter Thompson about maybe 3 years ago now, I think. And it was in Southern California. I'll never forget, you guys looked at me like, way too good to be true. Can you give me some of your thoughts on that, so everyone listening out there on this?
Yeah, I'm like, man, this guy, he's either crazy or he's found a no-brainer thing. And I think I'm definitely on the no. This is a no-brainer for people, right? It's great when you can find something like that people have a need for, and they don't realize it, right? And when you can solve these problems with these types of tools, it's crazy. It's amazing what you can do, right? So it's 100%. More people need to learn about this. I just had you on our podcast. We haven't released it yet, but super excited to get the word out because I'm a believer in it.
Thank you, brother. And by the way, if people want to learn more about that, you can go to capitalgainstaxsolutions.com to get started today. Do not let the wealth be locked up when you could have more freedom, more impact, more diversification, more cash flow, all the things we're talking about. But it starts with a plan, and it starts with getting educated on how this thing works. Go to capitalgainstaxsolutions.com. That being said, Mr. Ben Fraser, are you ready for the lightning round? All right. Knowing what you know now, if you go back to your 20-year-old self, what's the one golden nugget make sure to tell yourself to do?
Oh, man. Believe in a good God.
Amen. Question number 2, what are you most curious about right now?
Oh, man, how to raise a boy. I have 4 girls. I'm about to have a 5th who's my first boy. I am one, but I don't know how to raise these things, so I'm doing a lot of investigation into that.
Well, about 6 years ahead of you because I had 4 girls and a boy. I still call him a baby boy. He just turned 6 like 2 days ago. So I'll let you
Dude.
know, man. I'm still figuring it out too. Question number 3. Number one way you're using ChatGPT.
Oh man. Yeah, we're using it with a lot of our our content process. So we're not maybe using it to the full extent, but a lot of it just idea generation, just using it to, hey, in this realm, get us some insights or give me some ideas around this topic. And it's been a great tool to shortcut the content creation process.
Excellent question. Next question. Leadership quote. What's the number one you recommended or a theme that you try to live by?
Ooh, leadership quote. Nothing comes straight to my mind. One of the things that has kind of been a principle that I've always tried to live by, and I think it applies to leadership, is always produce more value than you're being paid to do, right? And I think in a leadership capacity, always be adding more value to those that you're leading than they're expecting. Because like in my mind, I always want to have the goodwill in my favor because it creates the buy-in, it creates the upward growth and trajectory. It creates the curiosity and the learning. So much of my growth path has been because I've just been a voracious learner. I just want to learn more things and I don't want to get stuck and stagnate. And I think as leaders, we always need to be learning, always need to be growing.
Awesome. With that, and top book or podcast or YouTube channel you recommend or you like the last year?
A big one for me has been Buy Back Your Time with Dan Martell. It's been a very helpful resource for me as a busy executive trying to find more time to keep growing and not stagnate and get stuck. And so it's given me a lot of tools to help get unstuck.
But I just read that book for the first time a month ago. Amazing book. He has a great YouTube channel as well. Definitely check that out. I think second to last question. What are you most curious about right now?
Well, I think aside from having a baby boy, yeah, I'm curious to see how the elections play out. I mean, I don't know when this will be released, but boy, it feels like a pretty crazy time right now.
100%. Last question, and it's this. It's all about the stewardship over ownership, kind of mindset and practice. So how do you best practice that, Ben, with all your success and the people you help to make sure you have a mindset of stewardship over ownership? And then what's something you're really passionate about giving away and blessing the most vulnerable people in this world?
Yeah, I think going back to something that I shared earlier, my view of stewardship is the gifts and the skills that I've been given are not for me and they're not mine. They were given to me. And so I am going to be held account, I believe, before God one day and say, what did you do with what I gave you? And I want to be able to say, I gave everything I could to maximize the gifts that you gave me, maximize the impact. And so that is really the underlying reason for my drive and growth is because I want to be a really good steward. There's a lot of ways I still need to grow in that, right? But to me, it's not about me. It's about using the gifts that God gave me to help those that are less fortunate. And I mean, right now it's the season of I have 4 young kids about to have a fifth. I see me investing in them as a present dad, as one who wants them to go and achieve their highest and best potential. God-given potential is my primary goal. And I think one of the main ways that I'm going to give back to the future of the earth.
Absolutely. Ben Fraser, it's been more than a pleasure to have you on the show. It's great to now call you a friend and also now strategic alliance with Aspen Funds. I want to encourage you to keep using your gifts of, always being pretty good at a lot of things, but also maximizing and being great at a few things, which you're doing right now with Aspen Funds, and finding your passion, your gifts, your talents to help and bless a lot of people, create and preserve more wealth, make a bigger impact. And of course, using the compounding eighth wonder of the world to maximize that impact. Appreciate you and what your dad is doing and what you guys do in Aspen Funds. For our listeners who want to get in touch with you, we remind them one last time, what's the best place for them to find you?
Just our website, Aspen Funds, funds.us.
Awesome. Thanks, Ben. I also want to thank all of our listeners for listening to another episode of the Build to Billions podcast. We're on this journey with you where we're being guided by successful entrepreneurs and investors, and hearing from how they have scaled and how they moved from millions to billions, right? Not just that, but also moving from for scaling for capital, for scaling for impact. And we believe that the key to doing all of this is to practice and a mindset and a practice of stewardship or ownership and applying billionaire biblical principles. And our ultimate goal is to help you scale and compound your wealth in life so you can give more all of it away. For MVPs, those are the most vulnerable people in this world. So we want to encourage you to do just that. Thank you so much for listening. Please rate, review, subscribe. Of course, if you have an exit coming up and you want some capital gains tax solutions plans to help you with that exit, go to capitalgainstaxsolutions.com. Appreciate everyone listening out there. We will talk to you all again real soon. Thanks so much. Bye.